This is something that has been well warranted for quite some time here. But as Ralph was talking about, vacuum market, vacuum rally, look at the way this market has traded over the last, hour, right? There's not enough volume here to really support these swings that we're seeing. The imbalances came out, immediately it shot up, not enough volume on the sell side, and now we're pulling back in. So it is good to see the lack of major volatility, major 1-2% moves that we're seeing in the market. But in reality, the lack of participation here is going to magnify those moves any day.
But just on the point of volume, this week's been way higher volume than you would have expected for Christmas.
Not today, though,
Not
right?
today, but
Not
most
today.
of that volume has been coming in the opening and closing auctions. So that's where you're seeing a lot of the liquidity intraday. And as we get closer towards the end of the day, the volume has been, slowly picking up to there.
So how much credence, Kate, should we put in the action that we have seen in the market this week as far as knowing what to do next come January?
Well, I don't think you should pay much attention to what's happened this week because we have seen these big swings. I do think it's good news that towards the end of the day, investors have become more positive and we've seen stocks rebound. But I don't think this gives you much of a signal for what's going to happen in 2019, where the fundamentals will matter a lot more. I do think we continue to see volatility, although not at this level. And I think that what we'll see is a struggling market, but one that moves higher because the fundamentals are positive. That's economic growth in the U.S., that's economic growth globally, and it's solid earnings, even though they will be at a lower rate than what we were seeing in 2018. So I think all of those keep stocks positive, but you see this choppiness continue as stocks move higher, but not in a straight line.
Rick, what are the key levels you're watching on the dollar as we end out the year and into next year? Where do you expect us to be 12 months on?
For the rest of the year and for maybe the next month or so, I think monitoring the 96 level, which we haven't closed below in the dollar index since about the third week in October, is a good thing to monitor. But actually, for the future, you might be a little cautious if you're a dollar bull. And the reason is we've seen a steepening of the yield curves. And I'm not stressing this because they've gotten super steep. But the fact of the matter is steepening curves in a dropping rate environment highlights something, in my opinion, and that is less Fed. Less Fed. The market's thinking less Fed. And less Fed is not necessarily a positive dynamic for the dollar index. So I think that's a good thing to monitor. And as far as the yield curve, nothing sums it up better than looking at a 2-year note yield right now. So it's at 252, which means it's down 4 on the day, down a dozen basis points on the week. Whereas a 303 30-year bond is down 3 on the day and unchanged on the week. I think that really drives the point home about how the curve's been steepening in a dropping rate environment.